What if one of the safest places you can keep your retirement money is quietly costing you thousands of dollars every year? Not because the bank is failing, not because of a market crash, not because of a scam, but because of a hidden chain reaction that starts the moment your savings begin earning interest. Most retirees spend years trying to protect their money. They avoid risky investments, stay away from speculation, and move their cash into savings accounts that seem secure and predictable. On the surface, it looks like the responsible thing to do. The problem is that what looks safe on a bank statement can sometimes create consequences that are anything but safe when tax season arrives. The issue is not the money itself. The issue is how the income generated by that money interacts with Social Security taxation, Medicare premiums, and your overall tax picture. These are three separate systems, but they are connected in ways many people never realize until it is too late. For some retirees, a large balance sitting in a high-yield savings account can create a situation where the taxes and additional costs triggered by the interest income significantly reduce the benefit of earning that interest in the first place. In certain cases, the difference can be large enough that the retiree ends up far less ahead than expected. Today, we are going to walk through exactly how this works, why it matters in 2026, and how you can calculate whether your own savings balance may be creating an unexpected problem. Before we continue, take a moment to like this video and subscribe. Financial decisions are becoming more complex every year, and understanding how these systems work together can help you avoid expensive mistakes that most people never see coming. As always, this discussion is for educational purposes only. It is not tax, legal, or financial advice. Every person's situation is different, and any major financial decision should be reviewed with a qualified professional. Let's start with a simple example. Imagine a retiree who spent decades working, saving carefully, and avoiding unnecessary risks. She receives Social Security benefits, has a modest pension, and keeps a substantial amount of cash in a high-yield savings account because she wants security and easy access to her money. At first glance, everything appears perfect. The savings account is paying close to 5% interest. The money is FDIC insured. There is no stock market volatility. Every month the account earns more interest, and the balance slowly grows. Most people would look at that situation and conclude that it is a financial success story. But there is another side to the equation. When a savings account generates interest, that interest becomes taxable income. The bank reports it, the IRS sees it, and the amount gets added to the retiree's income for the year. That by itself may not sound alarming. However, the real issue begins when that additional income pushes a retiree across important income thresholds that affect other parts of the tax code. One of the biggest examples involves Social Security taxation. Many retirees are surprised to learn that Social Security benefits are not always tax-free. Depending on income levels, a portion of those benefits can become taxable. The calculation used by the IRS is based on something called provisional income. Provisional income is determined by taking your adjusted gross income, adding certain other income sources, and then adding half of your annual Social Security benefits. The resulting number determines how much of your Social Security may be subject to federal taxation. For single filers, specific thresholds determine whether none, some, or a significant portion of Social Security becomes taxable. For married couples filing jointly, different thresholds apply. What matters is not memorizing every number. What matters is understanding that additional income from a savings account can push you from one category into another. That is where many retirees run into trouble. Suppose a retiree is already close to one of these thresholds. Without realizing it, the interest generated by a large cash balance may push them over the line. The result is not simply paying tax on the interest. The result can be paying tax on a larger portion of Social Security benefits as well. Now the retiree is facing two separate tax consequences from the same interest income. First, the interest itself is taxable. Second, the interest causes more Social Security income to become taxable. That combination can dramatically change the true value of the interest being earned. Imagine earning several $1,000s in interest during the year. At first glance, that sounds excellent. But once federal taxes, state taxes, and increased Social Security taxation are factored in, the actual benefit may be far smaller than expected. Many people never perform this calculation because they focus on the advertised interest rate rather than the after-tax outcome. Banks naturally highlight the rate because that is the product they are selling. What they do not calculate for you is how that interest affects the rest of your financial picture. That responsibility falls entirely on the account holder, and that is where many retirees unknowingly lose money. The situation becomes even more important when Medicare enters the equation. Most retirees know Medicare premiums exist, but far fewer understand how income can affect those premiums. Medicare uses income information from prior tax returns to determine whether higher income retirees must pay additional amounts for Part B and Part D coverage. These additional charges are commonly referred to as income-related adjustments. Crossing certain income thresholds can result in noticeably higher Medicare costs. The important point is that recurring interest income contributes to overall income calculations. Every dollar of interest generated by a savings account becomes part of the broader financial picture that determines where a retiree stands relative to these thresholds. A retiree who is comfortably below a threshold today may not remain below it forever. Required minimum distributions from retirement accounts, pension income, investment income, or one-time financial events can all increase taxable income over time. If substantial interest income is already being generated every year, it reduces the margin of safety available before another threshold is crossed. This is one reason retirement planning is becoming increasingly complex. A decision that seems isolated often creates consequences elsewhere. A change in one account affects another calculation. A tax decision affects Medicare costs. An income increase affects Social Security taxation. Everything becomes connected. That is why looking at individual accounts separately can be misleading. Instead, retirees need to view their finances as a complete system. Every source of income interacts with every other source of income. Every financial product carries consequences beyond the headline rate or advertised return. A savings account may appear simple, but its impact can extend much further than most people realize. There is another area that deserves attention as well. Many retirees eventually receive large sums of money through property sales, inheritances, business transactions, or other major life events. When significant amounts of cash move through bank accounts, reporting requirements may come into play. Financial institutions operate under federal regulations that require certain transactions to be reported. These reporting requirements exist for compliance purposes and are not automatically an indication of wrongdoing. Unfortunately, confusion surrounding these rules has caused problems for many people. Some individuals mistakenly believe that keeping transactions below certain dollar amounts allows them to avoid attention. In reality, deliberately structuring transactions to avoid reporting requirements can create far greater issues than simply conducting the transaction normally. The safest approach is honesty and transparency. If a legitimate transaction requires a large amount of cash, there is generally no reason to manipulate the amount in an attempt to avoid routine reporting procedures. Retirees should be particularly careful because major life events often involve larger sums of money than they handled during their working years. Selling property, helping family members, receiving inheritance proceeds, or restructuring retirement assets can all create situations where misunderstanding the rules becomes costly. Fortunately, awareness goes a long way. Understanding how these systems operate reduces the likelihood of making decisions based on myths, rumors, or incomplete information. The larger lesson here is simple. Financial institutions, tax agencies, and government programs all operate according to their own rules. Those rules frequently intersect. The challenge for retirees is not merely finding a safe place to store money. The challenge is understanding how every financial decision affects the entire retirement plan. A high interest rate may look attractive. A growing account balance may feel reassuring, but neither number tells the whole story. The only number that truly matters is what remains after taxes, fees, premium adjustments, and other consequences have been considered. That is the calculation most people never perform. And that is often where the biggest surprises are hiding. So how can you determine whether your own savings balance may be creating an unnecessary tax burden? The first step is understanding your current income picture. Start by listing every recurring source of income you expect to receive during the year. This includes pension payments, retirement account distributions, dividend income, rental income, part-time employment earnings, and any other regular income sources. Next, determine the annual amount of your Social Security benefits. Once you have those numbers, you can begin estimating where you stand relative to important income thresholds. Many retirees discover that they are already much closer to these thresholds than they thought. That realization alone can be eye-opening. What appears to be a harmless increase in interest income can have consequences that extend far beyond the savings account itself. The goal is not necessarily to eliminate interest income. The goal is to understand how much interest income can be generated before it begins creating additional cost elsewhere. For some retirees, the answer may be that nothing needs to change. For others, a different approach to asset placement may improve overall efficiency. The key is making decisions based on complete information rather than assumptions. One common mistake is focusing entirely on gross returns. A retiree sees a bank advertising a higher rate and immediately moves a large balance to capture the additional yield. From a purely banking perspective, that decision may seem logical. However, retirement planning requires looking beyond the headline number. A larger interest payment does not automatically mean a better outcome. What matters is the net result after every consequence has been considered. This distinction is critical. Two retirees could earn exactly the same amount of interest and experience completely different outcomes depending on their overall financial situations. One retiree may remain comfortably below important thresholds and keep most of the benefit. Another retiree may trigger additional taxation and premium increases that significantly reduce the value of the interest earned. The account itself is identical. The outcome is not. That is why personalized calculations matter. Many retirees also overlook the long-term impact of required minimum distributions. As retirement accounts grow and required distributions begin, taxable income often increases automatically. Someone who appears safely below an income threshold today may find themselves much closer in future years. Adding substantial savings account interest on top of those future distributions can create additional pressure. This is especially important because retirement planning is not just about the current year. It is about managing income over decades. Every decision should be viewed through both a short-term and long-term lens. The question is not only how much interest you will earn this year. The question is how that interest fits into your broader retirement strategy over the next 5, 10, or even 20 years. Another factor that deserves attention is inflation. Many tax-related thresholds have not always kept pace with rising costs of living. As incomes gradually increase over time, more retirees find themselves affected by rules that may have originally targeted a much smaller group of taxpayers. This phenomenon often occurs slowly. A retiree may not notice any issue for several years. Then, seemingly all at once, a larger portion of Social Security becomes taxable, or Medicare costs begin increasing. In reality, the change was building gradually in the background. The interest income generated by large cash balances can accelerate that process. This does not mean savings accounts are bad. Far from it. Savings accounts serve important purposes. They provide liquidity, stability, emergency access to cash, and protection from market volatility. Every retiree needs some level of accessible cash reserves. The question is not whether savings accounts should exist within a retirement plan. The question is how much money should be kept there relative to other available options. That answer will vary from one household to another. Some retirees prioritize liquidity above all else. Others may prioritize tax efficiency. Some may have significant pension income. Others may rely almost entirely on Social Security. Because every situation is unique, there is no universal number that works for everyone. What matters is identifying the point where additional interest income begins producing diminishing returns. Once that point is reached, it may be worth exploring alternatives with a qualified professional. For some people, tax advantage strategies may help improve efficiency. For others, different investment structures may provide a better balance between income, taxes, and flexibility. The specific solution matters less than the process. The process is what protects retirement income, and that process starts with awareness. Unfortunately, many people never perform these calculations. They assume that if a financial product is safe, it must automatically be beneficial. They assume that if interest rates rise, earning more interest must always be good. But retirement planning is rarely that simple. Every benefit comes with trade-offs. Every source of income has consequences. Every decision influences another part of the financial picture. The retirees who achieve the best outcomes are often not the ones earning the highest returns. They are the ones who understand how all the pieces fit together. They know that a retirement plan is not a collection of separate accounts. It is a connected system. When one component changes, the rest of the system reacts. Understanding those reactions can make an enormous difference over time. That is why financial literacy remains one of the most valuable assets a retiree can possess. The more you understand, the more control you have over the outcome. You do not need to become a tax expert. You do not need to memorize every regulation. But you should understand enough to ask the right questions. How much interest am I generating? How does that interest affect my taxable income? Could it increase the taxation of my Social Security benefits? Could it affect future Medicare costs? Am I evaluating the net result or only the advertised return? Those questions alone can reveal opportunities that many people miss. The reality is that no bank, government agency, or financial institution is responsible for optimizing your retirement strategy. Each organization focuses on its own role. Banks offer deposit products. Tax agencies administer tax rules. Medicare administers healthcare programs. None of them are tasked with showing you how every piece fits together. That responsibility belongs to the individual retiree and the professionals they choose to consult. This is why proactive planning matters so much. Waiting until tax season often means the opportunity to make changes has already passed. By the time income appears on a tax return, the decisions that created that income have usually already been made. Planning ahead provides flexibility. It creates options. It allows retirees to make adjustments before the consequences become permanent. The most important takeaway from today's discussion is simple. Do not judge a financial decision solely by the return it promises. Judge it by the outcome it produces. A 5% yield may look attractive. A growing savings balance may feel secure. But the real question is how much of that benefit remains after every tax and income-related consequence has been accounted for. That is the number that truly matters. Take some time this week to review your own situation. Look at your income sources. Review your annual interest earnings. Consider how those numbers fit into your broader retirement strategy. And if you are unsure, schedule a conversation with a qualified professional who can evaluate the entire picture rather than focusing on a single account. Small adjustments made today can potentially prevent expensive surprises later. Retirement is too important to leave to assumptions. The people who protect their wealth most effectively are often not the ones chasing the highest returns. They are the ones who understand the rules, monitor the numbers, and make decisions based on facts rather than marketing. Knowledge creates options. Planning creates confidence. And understanding how every part of your financial life interacts with the others can help you preserve more of the money you worked so hard to save. If you found this information valuable, share it with someone who may benefit from hearing it. Many retirees never realize how closely savings account, interest, taxes, Social Security, and Medicare can be connected until after the consequences appear. A simple conversation today could help someone avoid a costly mistake tomorrow. Thank you for watching, and remember that financial security is not just about how much money you have. It is about how effectively you manage every dollar within the system that governs retirement income. Benefits. Blueprint, USA.